In Chapter 4, we're going to concentrate on accounting for merchandising companies. So first, let's answer what is a merchandising company. You may have not noticed, but up until now, when we've been looking at revenue, we've called it service revenue. And a service revenue comes from a company who provides a service in order to make money. On the other hand, a merchandising company is a company that makes a sale of a particular product in order to make money. So the reason we've been looking at service revenue up until now is because recording service revenue is relatively simple. Now when we add in the idea of a merchandiser, when they make a sale, we also have to look at the fact that when they make a sale, we'll recognize a new type of cost, and that's the cost of goods sold, which this is simply how we recognize the fact that whatever we sold cost us money. We need to show that cost through cost of goods sold, but we also need to now take that inventory or those goods off of our books. We're then going to look at gross profit. Gross profit is simply your sales minus your cost of goods sold. Then you take out the rest of your expenses. These are our general selling and administrative type expenses. And then we'll come to our net income. So you can see by just this basic diagram that merchandising is more complicated. As we look into merchandising, we're going to also concentrate on just a couple types of merchandising. We're going to concentrate on wholesaling and retailing. Manufacturers can also be a type of merchandising company because they produce a product in order to sell it. However, manufacturing is also much more complicated than your basic wholesaler or retailer. A wholesaling or a retailing company is a type of company that purchases their goods from another company in order to make that sale. A manufacturer, on the other hand, they are creating their own products, and the process of manufacturing can be very complicated to account for. So at this point, we're just looking at your basic wholesaling and retailing. A wholesaler is someone who purchases from a manufacturer, and then they sell, generally in large quantities, to your retailers. Retailers, on the other hand, typically purchase from a wholesaler, and they are the people who are selling to the direct consumers. So moving forward, let's get a little bit of a better idea of reporting the income for a merchandiser. If you'll remember, a merchandising company is someone who sells products to earn a revenue. So they're adding some type of markup upon whatever they bought, and they are selling it in order to earn money. So a merchandiser has their net sales. This is basically their revenue, whatever they have sold, minus their cost of goods sold gives us the gross profit. Subtract out additional expenses, and this gives us our net income. If we were working with a manufacturing company, cost of goods sold would not be quite so simple, because here cost of goods sold is just simply what those goods cost you to purchase. A manufacturer, on the other hand, the cost of goods sold is much more complicated because it's going to include all of their raw material purchases, their work in process, their finished goods, and all the things that go into the overall manufacturing process. So again, right now we're just concentrating on merchandising. So to get a basic understanding of the flow of our cycle for a merchandising company, first, we have the company makes whatever purchases of inventory that they're going to buy. So we then have our merchandise inventory. We'll make sales. Some of those sales are going to be directly in cash, and others will be in credit sales. So if we have credit sales, we then are going to have an accounts receivable, and there'll be a bit of time between when we issue accounts receivable and when we get the cash for those items. So the full operating cycle is from when they purchase their goods to when they actually sell those goods and then get the cash for those goods. We have some basic inventory systems that we're going to look at with a merchandising company, but the basic idea here is that any company typically begins whatever period they're working with some type of beginning inventory. That's because, so let's say that we're looking at an operating period that is the coming year. So from January 1st, 2016 to December 31st, 2016. When we start work on January 1st, we're typically going to already have some inventory on hand. Why is that? That's because we want to be prepared for the customers that we have on January 1st. We don't start buying our inventory on January 1st because then when we had customers come in on that first day of the year, we wouldn't have anything to sell them. So we typically prepare for our first sales by having some type of inventory to begin with. So the inventory that we begin with plus whatever inventory we purchase tells us the total amount of merchandise that we have had available for sale. So this is everything that we had on sale for our customers. Then at the end of the period, the difference between what we had available and now what we have in our ending inventory is going to tell us what did we actually sell, because everything that we had on hand minus what we sold gives us our ending inventory. So just get an understanding of how cost of goods sold, ending inventory, and merchandise available for sale all work. We have two basic types of inventory systems. In this class, we're going to concentrate on perpetual systems, and that's because perpetual systems are typically what are used today. The reason is because we have computers that can continually update our accounting records for our transactions as they're happening. A periodic system, on the other hand, only updates their inventory periodically, meaning they will make purchases and then they do not actually record the sales of those purchases. They're not recording the cost of goods sold for every sale as they go. Instead, at the end of the period, they're going to then go and count their goods, and the difference between what they had to sell versus what is actually on hand when they do that inventory account, the difference there is going to be the cost of goods sold. On the other hand, a perpetual system, this is something like you see in the grocery store when they're scanning the items that they're putting into their cart. From your perspective as a consumer, they're just scanning them to get the price. But from that retailer's point of view, yes, they're scanning to get the price and to get their actual revenue, but also every time they scan an item, it is reducing that item from their inventory because they have a perpetual system, which means they are perpetually keeping that system updated. Now, that's not to say that perpetual inventory systems don't have inventory counts. They do have inventory counts, but they don't rely on those inventory counts the way that a periodic system does. Perpetual systems, instead, they're perpetually updating their accounting records for the sale of their goods. Then, at the end of the year, they'll do an inventory count, and they'll compare what they think that they should have, based on their books, to what their inventory count tells them they have, and generally there'll be a small difference, and they'll update their books for that difference. Now, that small difference is typically due to maybe some things spoiled, some things were lost, some things were stolen, things like that. A periodic system, on the other hand, they are not keeping their accounting records up to date. They're recording the fact that we had an inventory purchase, but we're not reducing our inventory as we sell items. Instead, in order to update or figure out how many items we sold and therefore what our cost of goods should be, we are totally relying on the inventory count at the end of the year to update our books and to record our cost of goods sold. So although the appendix of this chapter goes over periodic systems, in our lecture we're going to concentrate on perpetual systems because it's typically what you'll see in today's accounting environment. So how do we actually record transactions as we move through the perpetual system? And first we're going to look at the purchase of merchandise. So this is as if you are the retailer and you're purchasing merchandise in order to sell to your customers. So how do we record these merchandise purchases on our books? So our first example is that on November 2nd, we purchased $1,200 of merchandise and we paid cash. So we're going to increase our merchandise inventory by $1,200 and we'll decrease our cash for the amount that we paid. Now, merchandise inventory is an asset on our books. Typically, it's a short-term asset because you generally buy inventory with the intent of selling it within the coming operating cycle. Therefore, it's short-term. But this is an asset, and if you remember, assets increase with a debit and assets decrease with a credit, and that's why we're crediting cash to show it decreased. If this had told us that we purchased it with an account payable, we would simply debit account payable because that would increase that account payable liability. However, this was pretty simple. We paid with cash, so we're going to show the reduction of cash with that credit. Now we're going to introduce the idea of a trade discount. A trade discount is a type of discount given on the things that you purchased. So we purchased $1,200, but what happens if we get some sort of trade discount? What you can see here is this is our basic invoice. You can see this is for the total amount that we purchased, but now let's introduce the idea of a trade discount. You can see here in the terms, we have terms that are 210 net 30. So what does that even mean? What it means is that if we pay this invoice within a certain number of days, we will get a discount. So this tells us that if we pay within 10 days, we will get a 2% discount. So you could read this as a 2% discount if paid within 10 days. Otherwise, we'll pay the net amount or the full amount within 30. So $1,200 if we pay within 30 days. The bottom line is that this invoice is due within 30 days. If we do not pay this by the end of 30 days, they're going to start calling us and trying to collect on their money. However, typically companies want to get their money as soon as possible, so they are encouraging us to pay as soon as possible. So what happens if we take this 2% discount? It's important to remember that when we purchase goods, we're showing that we put inventory on our books at a value of $1,200 because this is our historical cost. But then what happens if we get this 2% discount? Should that change the value of our merchandise inventory? Because remember, we want to keep our inventory on our accounts based on the principle of historical cost. So I'll go ahead and tell you, if we do get the 2% discount, we'll need to reduce our merchandise inventory for that amount. And let's go through and actually see how this works. So again, here's just a basic timeline. We have our full timeline of when we purchased our goods, and then at the very end of this timeline is when it is due. However, if we pay within this discount period, we're going to get that 2% discount. Otherwise, we have an additional 20 days to wait before we pay, but if we wait the full amount, we have to pay the full $1,200. The truth is, though, although most companies do want to go ahead and pay quickly and get that 2% discount, you don't always know if you're going to be able to do that. So when we go ahead and we book the fact that we purchased goods, we're going to book them at the full amount. And then if we do indeed get that discount, we'll go back and make the adjustment for that. So here's our purchase discount, 2% discount if we pay in 10 days. Otherwise, the net amount, or all of it, is due within the full 30 days. So what happens here? On November 2nd, we purchased that $1,200 of merchandise inventory with the following credit terms. So in this case, we purchased goods, but we did not pay in cash. So we've paid with accounts payable. And now we're told if we pay that within 10 days, we get a 2% discount. Otherwise, we pay the full amount. So, let's say that we go ahead and pay, and we did indeed pay within 10 days. So when we do that, we pay off 2% less than what we originally had to. But this can be tricky. Here we have our full accounting journal entry. We're going to reduce accounts payable by the full amount, $1,200. You see, we booked accounts payable for $1,200. And that is because we had an obligation when we purchased this inventory that we owed someone a contractual amount of $1,200. Now when we pay them, they are offering us a discount because we paid quickly. So even though the cash that we pay them is not going to be this full amount, we still get to reduce the accounts payable by the full amount because we have fulfilled our contractual obligation. So then, how much do we actually pay? We pay the difference of 2% of $1,200. So 2% of $1,200 is $24. So we pay $1,200 minus $24. This is the cash that we're actually going to pay to fulfill our contractual obligation. So we pay $1,176. So if we were to leave our journal entry with just the accounts payable and the cash portions, you'll see that our debits and credits would not be in balance because we reduce accounts payable by the full amount, $1,200, because contractually we have fulfilled our obligation. The company offered us this 2% discount. So we took that 2% discount and we paid them cash of the difference between what we originally owed minus 2%, and now we have totally fulfilled our obligation to them. They can't come back to us later and say, oh, you didn't pay us the full amount. The contract said we could take this discount. So now you can see we are not in balance because there's a difference of $24, which is the amount of the discount that we took. What we do is we need to now have a credit for $24. You can see here when we credit for $24, if you sum up your credits, those are going to equal the total of your debit of $1,200. But what is this credit? We credit merchandise inventory because remember, we want to have our inventory on our books at their actual cost. If you'll remember, if we go back a slide, we purchased this inventory originally for $1,200. But did it really, in the end, cost us $1,200? No, it cost us $1,200 minus $24. So in the end, it cost us $1,176. So when we debit merchandise inventory for $1,200 and then we credit it for $24, the sum of that merchandise inventory T account is going to be $1,176, which is the actual cost of those goods. So this is how your purchase discount works. You go ahead and you purchase your goods, record them at the full amount, and then if and when you take a discount, you'll record that entry as such. You reduce your accounts payable, you pay whatever cash it is you have to pay out, and then the adjustment is going to be to reduce the merchandise inventory to the actual amount that you ended up paying in cash. So moving forward, we're now going to look at what we call purchase returns and discounts. And this is based on the idea that sometimes we purchase something and we decide that we don't want it or it's incorrect, so we will return it. Another idea here is a purchase allowance. And this is the idea that, let's say that we as a company purchase something and for some reason we're sent something that is defective, or maybe it's the wrong color. Rather than sending it back, sometimes someone who has sold something to us will offer what we call a purchase allowance. And they say, rather than returning this item, how about we simply give you a type of a discount, and we call this a purchase allowance because it is a discount that is allowed based on the fact that something was defective or somehow unacceptable. An example would be, let's say that you are a grocery store and your basic color is green. That's kind of your trademark color, and you purchase a number of balloons for your grand opening. However, on grand opening day, you get those balloons and they're red. You could either return them or you could accept an allowance. And let's think about, you're having a grand opening and you want balloons. Yes, these are not the colors you originally intended, but they're still balloons. They show we're having some kind of celebration. So you know what, we'll keep them. We're not happy that they're the wrong color, so our supplier is going to give us an allowance. So rather than making us pay $100 for the balloons, they're going to give them to us for half off. This is the idea of an allowance. It's a way to get someone to keep something rather than sending it back. Because oftentimes when a company has something sent back, it's damaged, they simply don't want it. There's a lot of work to go and put it back in the warehouse. So one way to keep that from happening is by offering this an allowance. And it's an incentive to get someone to keep something. So how do we actually account for these allowances? So here we're just building on our previous example. We have the company who was the buyer, and they're now going to have a debit memorandum for an allowance that was given to them by whoever it is that they're purchasing from. So we're going to show this allowance by debiting our accounts payable, we call this a debit memorandum, and crediting merchandise inventory, and we'll talk through why these make sense. We owed someone for the goods that we purchased. If we are issued this allowance, They're basically saying either you no longer owe us for this $300 worth, or if we had already paid cash, we would be getting our cash back. So still a debit would work, because to show that someone's giving us cash back, we would debit cash. So in this case, we had an accounts payable, meaning we owed someone. Now, because part of what they sent us is defective, they're saying, you know what, just keep it. We'll give you an allowance for that portion, so you no longer owe us for those $300. So we reduce the account payable. Then we also need to reduce our merchandise inventory. Just because we're not going to use this inventory doesn't mean that we just ignore it. We have to look at the fact that this inventory that we still have no longer cost us that portion of the amount. So we need to reduce our inventory by $300. So here we just have a summary example to look at our purchase discounts and our purchase returns and allowances. So our company purchased $1,000 of merchandise on June 1st with terms 210 net 60. So what they're telling us is we purchased something and we have not paid cash. So let's go ahead and make that recording. June 1st, we increase merchandise inventory for $1,000, and we increase our liability, our accounts payable, for $1,000. 2 days later, we returned goods worth $1,000 before paying we returned goods worth $100, and we still have not paid the invoice. So 2 days later, June 3rd, we're going to return some goods. If we return them, we no longer owe for them. So first we need to reduce our accounts payable for that $100, and we also need to reduce the merchandise inventory for $100. So this is an example of a purchase return. We reduce the liability for whatever amount we return, and we take that inventory on the books, because in this case we've returned it and we no longer have it. Then they tell us on June 11th they have paid within the discount period. So we're going to take a 2% discount. What's important is that we only take the 2% discount on what we owe. If you'll remember, originally we owed $1,000, but we returned $100 of that. So now we only owe $900 worth. So you apply the 2% discount on $900 of accounts payable, not on the original balance of $1,000. So we will reduce accounts payable by the full amount that was remaining, $900. And then how much cash do we pay? We pay the difference between $900 and the 2% discount. A 2% discount is $18. So $18 from $900 is $882 of cash that we will actually pay. And that $18 discount is going to be a reduction to merchandise inventory. Because we paid quickly, because we paid within that discount period, we were given the 2% discount. So our merchandise inventory did not cost us $900. Instead, it cost us $882. So by recording this credit to merchandise inventory, we are bringing our merchandise inventory balance down to its actual cost of $882. We now want to introduce the idea of whoever owns inventory when it is being shipped is the person that is legally responsible for that inventory, and that also has an impact on how we treat the freight that is charged to transport that inventory. We have two different terms that you'll need to learn. This is basically FOB shipping point and FOB destination. FOB is just a shortening of free on board or freight on board. What this says is if it's FOB shipping point, we are told that the ownership of the goods transfers when the goods are shipped, so when it leaves the shipping point. FOB destination, on the other hand, tells us that the goods do not transfer ownership until they reach their destination. So here is just a depiction of what we're talking about. The carrier is when something's on a truck being delivered or on the road. So we have the seller here, this is the shipping point, and this is the destination. So if goods are transferred FOB shipping point, that means that as soon as we transfer the goods to the carrier, they have transferred ownership. So FOB shipping point, the buyer owns them while they are on the carrier until they get to them. If they are FOB destination, that means that ownership does not transfer until they reach the destination. So if ownership doesn't transfer until here, who owns it while it's on the road? The seller does. If the buyer owns the goods on the road, they are the ones that are going to pay the transportation costs. So if it's FOB shipping point, ownership transfers here when it's delivered to the carrier. So the buyer has to pay the cost to ship the goods. If the buyer pays the cost to ship the goods, that cost is built into the cost of the inventory. So if the buyer pays the freight, you will increase the value of the merchandise inventory by the amount of that freight. On the other hand, if the seller is the person that owns the goods while they are being shipped, so if the seller here owns the goods when they're being shipped, that means that this is FOB destination. In that case, the seller is going to recognize delivery expense for the amount of the freight. So how do we actually show this journal entry if we are the buyer and we are the ones who own the goods and therefore we pay the freight? So we purchased some merchandise on terms of FOB shipping point. We are the destination because we are the company that has bought these goods. If they transferred goods or if they transferred ownership at shipping point, that means that we owe them on the road the whole time that they're coming to us. So we have to pay the transportation charge. Because we are the people that own the goods, we will build this into the cost of our goods. So we will increase our merchandise inventory by $75 because these goods actually cost us the price that we paid now plus the freight of $75. So by debiting merchandise inventory by $75, we're increasing the value of the inventory to their actual cost. And then we're paying cash in this case, so we're just showing the credit to cash. So here we just have a basic example of a schedule of merchandise purchases. You'll see here this is the full cost of the merchandise we purchased. We'll then show a reduction for any discounts that we received and any returns or allowances that we received. You'll increase the cost of that merchandise for any transportation that you paid because you had purchased goods that were FOB shipping point. Therefore, you as the purchaser owned them while they were in transit, so you paid the freight. Therefore, they are part of your merchandise cost. Here, this gives us the sum is the total cost of our merchandise purchases. So the cost of our merchandise is not simply the original contractual price. It's going to be adjusted down for discounts, returns, and allowances, and up for the cost of any transportation that you paid to get it to your place of business. We're now going to shift gears. The previous section, we were looking as if we were making the accounting transactions as the company that was purchasing. So we were a retailer purchasing goods in order to sell to our customers. Now we're going to shift gears, and we are still that same company, but we are going to look at the accounting transactions that show us as a retailer actually making sales to our customers. So let's begin looking at this. Here's our basic idea of what we're going to be doing. When we are calculating our sales, we are going to need to track sales discounts and returns and allowances. But now we are going to be giving these things because we are the person making the sale. So how do these affect our revenue? First, we have our total amount of revenue. This is the full amount of the sales that we as a company make to our customers. Then we may offer sales discounts, and this is where we as a company are trying to get people to pay their accounts payable quickly. And so when we get that money quickly, we offer a sales discount. That sales discount is a reduction to our revenue. We'll look at how this works, but sales discounts and returns and allowances are what we call contra revenue accounts because they reduce our revenue. So an increase in a discount or an increase in an allowance reduces revenue. So a sales return or allowance is where someone's not happy with something and they either return it or we offer a discount and allowance. And so those are also going to be a reduction to our revenue. Sales minus discounts and allowances brings us to our net sales. So this is of our total sales. What is it that we actually keep? We'll then subtract out the cost of goods sold, and this gives us our gross profit. So let's keep moving forward. When we make a sale of merchandise, we're going to have to make 2 journal entries. We need to show the amount of the revenue that we receive, and then we will either get an account receivable or cash. We will also need to recognize the cost of what it is we sold. So you've already done the revenue portion when we were accounting for service revenue. So this is old. We're going to add some detail to that, but the basic journal entry of recording revenue is old. What is new is now we are going to recognize our cost of goods sold, which is an expense for whatever the goods that we have now sold cost us. So now let's work through an example of the journal entry to record the sale of merchandise. So we as a company have sold merchandise on credit. So first we need to record the sale of this merchandise. We sold for $2,400. So we have now earned revenue of $2,400. We did not get cash, so we're going to recognize an asset in place of cash, and that's our accounts receivable. So accounts receivable increases by $2,400, and then we're showing the earning of revenue by crediting sales for $2,400. Then we're told that the merchandise cost us $1,600. So we need to recognize the expense, and this is the expense related to making a sale. So cost of goods sold, $1,600. Then, because we sold something, we gave our inventory to someone else. So we no longer have this inventory on our books. So we need to reduce our inventory by the full amount that we sold. So we will reduce our merchandise inventory, which was an asset. We reduce that with a credit for the full amount of whatever it cost, $1,600. So now what happens if we offer a sales discount? Remember, a sales discount is some type of discount given if someone pays quickly. We already looked at a sales discount if we were the ones purchasing, but now we are the ones offering the discount. So we had an account receivable, and we want to collect on that quickly because we want to get our money in quickly. So we are offering a discount if someone pays us early. So how do we actually account for that discount? Here we have a credit sale, and the terms are $210 net 60. 2% discount will be given to our customer if they pay us within 10 days. Otherwise, they can pay us the full amount in 60 days. So originally, we go ahead and recognize accounts receivable for $1,000 and sales of $1,000. Now, they pay us in the full 60-day period. We're looking at 2 different scenarios. If they paid in 60 days, they owe us the full amount. So this is pretty simple. We simply show cash for $1,000 and accounts receivable reduced for $1,000. But let's look at the other scenario. What happens if they pay us within the 10-day discount period? If that happens, we are going to offer them the 2% discount. What is very important is when you give a sales discount or returns or allowances, you do not directly reduce your revenue. Instead, you book an entry to your contra revenue account, and you'll see this below. So here, we are going to first reduce the account receivable by the full $1,000 amount, because when they pay us the discounted amount within the discount period, they have fulfilled their contractual obligation. So they have fulfilled the entire amount that they owed us. Even though we're going to get less than this, The contract is now fulfilled, so they no longer owe us anything. We only get the amount of cash, which was what they owed us minus the discount. They owed us $1,000, but we're giving them a 2% discount. A 2% discount on $1,000 is $20. So we're going to get $1,000 minus the $20 discount, or $980. Now we need to recognize that $980 does not balance with the $1,000. So in order to make our journal entry balance, or our debits and credit balance, we need another debit, and that debit is going to be the amount of our discount. Let me emphasize, you do not simply reduce your sales by debiting your sales account. Instead, you debit sales discounts, and sales discounts is a contra revenue account. If you'll remember up here, revenue increases with a credit. So an increase to a contra revenue account is going to be the opposite. That is why we are debiting sales discounts, because sales discounts in the end reduces sales to the net sales amount. So sales and returns and allowances typically involve dissatisfied customers and the possibility of lost future sales. So in order to keep people happy, we will either accept a return or we will reduce the amount that they owe us, and that's an allowance. That's the same thing as what we were looking at before when we were the purchaser. We were unhappy for some reason. So let's look at our example here. Let's say we had this sale for $2,400, and those goods had cost us $1,600, so this is basically our previous example. And our customer now is returning part of the merchandise. What they are returning is the items that were sold. The value of those, we sold them for $800, and they cost us $600. So how do we account for this? It's going to take two entries to account for this. First, we need to show the reduction in our revenue through our contra revenue account, and then we'll need to show the return of our goods. So here, we need to reduce our revenue by $800, and we do that by debiting this contra revenue account, sales, returns, and allowances. Again, do not simply debit sales. You will be incorrect. You have to debit the contra revenue account. Sales, returns, and allowances is going to be debited for the full amount of whatever it is they purchased. $800 worth of goods was what we charged them for these goods. And now they no longer owe us for these. So we're going to reduce the accounts receivable for that amount. Then we need to show they actually returned these goods. So we are going to increase our merchandise inventory by the full amount that they returned. And then we need to reduce the expense because it is no longer goods that we sold, so we no longer have this expense. So we are going to show this expense being reduced by crediting the expense. Now what happens if instead of returning the merchandise, we tell them, keep the merchandise, but we will reduce the price for you. In this case, we only need one entry. Because they're not returning the goods, we don't have to make any kind of adjustment to our cost of goods sold or our merchandise inventory. Instead, all we need to do is to account for the allowance and to show the change in our accounts receivable. So in this case, because this is simply a price reduction, we are not returning the goods. So we're showing sales, returns, and allowances, this contra revenue account increasing by $100. And then we're saying you no longer owe us for this portion. So we are going to reduce our asset, which was our accounts receivable, by $100. Now we've already talked about adjusting journal entries and closing journal entries, but now that we're talking about a merchandising company, we're going to briefly mention the adjustments and closing entries needed for these types of companies. Here's just your basic cost flow of our accounting cycle. And you can see here this dotted line represents the change in your accounting periods. So what we'll need to do is anytime we're moving from one accounting period to the other, we need to get our books up to date and we need to close any of our income statement temporary type accounts. So the ending inventory, whatever we end with from period 1, will be our beginning inventory at period 2. So we want to make sure that before we move into the next period that we get this ending inventory completely up to date. And we'll do that by comparing what our books say we should have to an actual inventory account. And we will make an adjusting entry for any difference between the two. On the other hand, we also need to close out any of our temporary accounts. So those are our revenue accounts, our expense accounts, and our dividends. In this case, nothing with closing is new, except you have to remember now that we have contra revenue accounts, we'll also need to close those. Because contra revenue accounts work the opposite way of our typical revenue accounts, you'll close contra revenue accounts along with your expense accounts. And we'll look at that real quickly in a slide or two. So first, let's look at the adjusting entry needed for a merchandising company. So a merchandiser using a perpetual inventory system is required to make an adjustment to update their merchandise inventory account to reflect any difference between their actual inventory account and what happens when they actually go out and count their inventory. Their books typically say what they should have under perfect conditions. However, when they go out and count and see what they actually have, often there will be a difference, and that's because things can be lost, they can be broken, things can be stolen. So the difference between those is going to be a recognition of cost of goods sold. Because we lose things or things are stolen, this is simply part of the cost of being a merchandising company. So we recognize that by increasing our cost of goods sold, and then we will decrease our merchandise inventory to get our books up to date. So for example, this is an adjustment for $250. So let's say our books said that we should have inventory of $1,000. But when we go out and count, we only have inventory that counts up to $750 worth of goods. That means that we need to make that adjustment to reduce our books to show that we only have 250 less on hand than what we thought. This entry here will increase our cost of goods sold by $250, and it will reduce our inventory that is on our books from $1,000 to what we actually counted, which was $750. Here we just have a basic explanation of our closing entries. Here we'll just close revenue into income summary. Then, if you'll remember, we have to close all of our various expense accounts also into income summary. Now, any sales discounts and returns and allowances or cost of goods sold, we will now also need to close those into income summary along with all of our expenses. Remember, sales discounts and our sales returns and allowances, these are contra revenue accounts, meaning they work opposite of revenue. So that's why we're closing them along with all of our other expenses. Cost of goods sold is just another expense, and so that's going to be closed along with all these other expenses. None of the other closing entries have changed. We then close income summary to retained earnings, and then if we had dividends, we would also close those directly to retained earnings. Finally, we're going to be looking at a multi-step and a single-step income statement. The difference here is how our information is going to be laid out. We're not changing our expenses. We're not changing our overall income. We're simply showing it in a different way. So here we have a multi-step income statement. And a multi-step income statement is just going to show different groupings of information to give us different subtotals or steps that get us to our final net income. So first you'll see here we have our sales information. We're going to have our sales minus the things that make up our net sales. That's our sales discounts and sales returns and allowances to get to our net sales. We'll then reduce net sales for our cost of goods sold, and that gives us our gross profit. Gross profit is important because we need to have an understanding of our total sales. What did the goods that we actually sold cost us? and the difference between those is our gross profit. We're then going to have all of our various operating expenses. So these are the day-to-day expenses that it costs us to operate our business. These are our normal operations. So our gross profit minus our various operating expenses gives us our income from operations. So this is telling us our basic day-to-day operations. How are we making income? Finally, here we have our other types of revenues or other types of expenses, and these are kind of the abnormal things. These are not things that we earn or have that are part of our regular operations. So if we are a company that is a merchandising company, our operations are the purchasing and sales of goods. Anything that falls outside of those typical operations is going to be shown in this other revenues or other expenses. An example would be interest revenue. We are not in the business of loaning out money and earning interest. So if we do have some type of interest revenue, we're going to show it in the other section. The same with a type of a gain on the sale of a building, or the same with the gain on the sale of land or machinery. We are a merchandising company. We are not in the business of selling buildings or land. So any gains that we have from that, we're going to show in this other section. And then also interest expense. Interest expense is going to be shown down here because this is a non-operating type of activity. It's not our typical type of expense. And here we have our total net income. On the next slide, we have a single-step income statement. What's important is that no matter how we show this, net income is the same. But a single-step income statement is simply going to lump all of our revenues together and all of our expenses. A multi-step income statement gives us a lot more information. From a multi-step income statement, we can quickly see what our cost of goods sold is, or what is our income from operations. So a single-step income statement, although it has the same net income number, it's much more simplistic and it doesn't give us as much information. Based on our income statements, we're going to look at a couple ratios. First, we're going to look at our acid test ratio and look at how it assesses a company's liquidity. We've already talked about other ratios, for example, the current ratio. The current ratio, if you'll remember, is simply your current assets divided by your current liabilities. The acid test ratio is very closely related to the current ratio. It's simply more stringent. So here's our formula for the acid test ratio. You'll see here we also call it the quick ratio, and that's because of the way we calculate our acid test ratio or the quick ratio. It's simply our quick assets divided by our current liabilities. But now we need to define what are our quick assets. If you'll remember, your current ratio is your current assets divided by your current liabilities. The acid test ratio is more stringent because now we're not looking at all of our current assets. We're only looking at the assets that are most liquid, or the assets that can most quickly be transferred into cash. So our quick assets or our most liquid assets are our cash, our short-term investments, or our receivables. Basically, we're not including things like our inventory because those are not as close to cash as cash, or short-term investments. In order to get cash for your short-term investments, all you have to do is go to the bank and say that you want to end your certificate of deposit, or if you had some type of stock investment, you can quickly sell that and get cash for it. The same is true for your receivables. An account receivable is a promise for what? It's a promise for cash. So these are very close to cash. If you'll remember, the current ratio is telling us, do we have enough assets to cover our liabilities as they're coming due? So the acid test ratio also does that, but it's more stringent because it's looking at, do we have enough cash or things that are fairly close to cash to pay our current liabilities as they come true. Now, a common rule of thumb is to have an acid test ratio or a quick ratio of at least 1. However, there are times when an acid test ratio may drop below 1, and that's just because companies have to look at when are these current liabilities coming due. Are they coming due at the end of this month, or are they coming due, in 9 months from now? Because remember, a current liability is something that is due within a year. So companies have to watch their current ratios and their acid test ratios to make sure that they have enough current assets, and in the end, do they have enough cash on hand to pay their liabilities as they come due. Finally, we mentioned gross margin when we were looking at that multi-step income statement. And gross margin is just the difference between your sales and your cost of goods sold. So we can now look at the gross margin ratio to help us get an understanding of how profitable a company is. Gross margin ratio is simply your gross margin, which is your net sales minus your cost of goods sold, divided by your net sales. The larger your gross margin ratio is, this means the more profitable you are, because this gross margin ratio is simply a percentage of dollar sales available to cover your expenses and your profit. What this is telling us is when we make a sale, what is left over from those sales after we have paid for these goods to be able to cover our operating expenses. And then once we've covered all of our various expenses, anything left over is a profit. So the higher our gross margin, the higher amount of money we have left over to pay our expenses, and hopefully then the higher our profit. So our gross margin ratio simply gives us an idea of the profitability of a company.